This week, I'm addressing a listener question as far as what's the best way to access equity in your home for retirement income. And to help answer that question, I'm bringing back a prior guest, Mitch Cooper. Welcome, Mitch.
Yes, thank you for having me back.
Yeah, to tell the listeners a little bit about Mitch, if they didn't catch the previous episode where we talked about reverse mortgages. Mitch is a certified reverse mortgage professional with Mutual of Omaha, who's been helping people since 2018.
Yeah.
I'm not familiar with the certified reverse mortgage professional designation. What is that?
Yeah, so that's a designation. It is created by another thing you're probably not familiar with, the National Reverse Mortgage Lending Association. And so, similar to kind of designations in the financial planning world, there's required continuing education every year. There's a test and everything at the beginning. Ultimately what it means for clients, there's very few. There's only roughly, a year or two ago, there were about 600,000 licensed loan officers, but there's only about 200 certified reverse mortgage professionals. So it just really is an indication of someone that actually is an expert in reverse specifically, because it is a different animal, and that they're dedicating their time. And of course, there's higher ethics standards and things like that as well. But
it must be difficult to complete if a lot of people haven't done it.
It's I think it's just dedication. Sure. I don't think it's extremely challenging, but it means someone's put the time in to really understand reverse.
Definitely. Yeah. So let me just set the stage. As I mentioned, I've had some listener questions that have mentioned real estate's been doing great. A lot of people, because they've got a low interest rate on their mortgage or maybe not even a mortgage, they don't really want to move or they can't move. And, they've got this asset, which is their primary residence. And, they're wondering how and when maybe is the best way to tap into that. So maybe we could talk a little bit about what are, how the reverse mortgage works versus like a home equity loan or a home equity line of credit and some of the pros and cons that might be good for people.
Yeah, absolutely. It's difficult to have a conversation about reverse and not bring up the statistic. I think I do it all the time. If you look at the makeup of the average retiree's assets, what's their asset allocation, stocks, bonds, the average retiree, 2/3 of their wealth is their primary residence.
Oh, wow.
And so you're talking about just this massive share of wealth. And like you said, what you're saying, whether it's the golden handcuffs that we now have of low interest rates, but really, if you kind of look at the housing asset, it's not an ideal asset from a retirement income planning perspective. It has a lot of disadvantages from that side of things, right? It's very illiquid. If you're going to go to sell, it's 6-7% in costs, that you're looking at eating out of the net proceeds. So it's got high transaction costs, but ultimately, really, it's that lifestyle and the deep emotional connection. If you're looking at, your clients probably aren't looking at which stocks you're selling to generate their distribution, right? Maybe you have the one in a
probably
thousand.
Not. They could have that one that they really love. Yeah, I'm never selling this one.
Looking at the statements or that, you have those interested clients, but most don't care. If you tell that client, hey, I've solved your problems, we're going to, meet all your goals, all we have to do is sell your house. You probably have tears in the office in most cases, unless they're already looking to move. There's a deep emotional connection, and really, your home is a lifestyle asset. So whether there's the consumption goods side of needing shelter, but that's really not why most of us are buying homes these days.
Sure.
And it's not a math problem. If it was a math problem, I wouldn't live in California. I'd move to Tennessee where I can buy a house for a quarter of the cost.
Yeah.
Right. But all my family's here. All my wife's family's here. That's a lifestyle asset, right? Or it could be being on the golf course or on the lake, whatever that is. It's different for everyone. Homes are really a lifestyle asset. And so that's why we own them. From a retirement perspective, they're not a great asset. It's just a lot of wealth.
They don't pay income generally. You're paying to keep them.
Right. Yeah, exactly. They're a consumption good. And so that's really where the reverse fits in is, okay, how can we create some liquidity? How can we start to actually spend down some of this asset without liquidating the true purpose, the lifestyle and the consumption good of that home? So you still get to use the home. You still get to have your grandkids over in the home, have the glass of wine on the back deck. It's your home. but we get to actually start spending it down how we would spend down an IRA or a Roth or 401k, and that's really the main purpose behind it.
Okay, so just talk about some of the basics of how that works. Like, can anybody take out a reverse mortgage if they want?
Yeah, there are some requirements. So it's very different, than a HELOC or a traditional loan. They're structured very different. They're really structured more like an insurance product. If you really compare the two, that they could look a lot more like an annuity than they would a mortgage. So there are requirements. There's age requirements. One of the borrowers has to be at least 62 for the FHA product, which 95% of reverse mortgages are an FHA product. So Department of Housing and Urban Development is making all the rules. FHA is monitoring all the rules. So it's very, very regulated. And it was put in place by Congress in 1989. So that's primarily what everyone's using now, because it's just a superior product. It has the most protections, has the most features. And so we talk about that product. One of the borrowers has to be at least 62 years old. And you have to have a significant portion of equity. We're limited heavily. If you think of a traditional loan, they might loan 80% of the value.
Okay.
A $500,000 house, they could loan $400,000. It's based on age and interest rates. So as interest rates have come up, we're going to be a lot closer to 30 or 40% of the value.
Okay. Of what someone can borrow.
Of the value of the home. So even if you have, sometimes we go, hey, I've got a $600,000 house, I owe $400,000, and we're like, oh, we have to pay off all the mortgages, and we're going to loan like $200,000.
Sure.
We're limited, and so the client could still do it, but they would have to write that check for the shortfall, and that's just, again, we're about adding liquidity, not usually taking liquidity away. So they could do it. It just usually doesn't make sense from a financial planning and goal oriented perspective.
Yeah.
Right.
Now, I thought in the past that was closer to like 60 to 65%.
So it depends on age, but it's also, the older you are, that could still be possible. But that's where interest rates have affected us.
Sure.
So when we were to give you kind of an example, a 62-year-old who we lend the least to, and the idea just being, again, the FHA sets all these limits. So it's same lender to lender. The only control the lender has is the interest rate to the extent that they can actually provide it. And so a 62-year-old back in 2020, when rates were 3%, was almost to the 50% mark. So we could loan probably about 48, 49%. Now we're at like 29%. So that is just strictly because of higher interest rates.
Yeah. What if you're 70 years old? Like, what's the percentage?
70 right now, going off the top of my head here, it's about 34%, I believe. Yeah. And again, it changes weekly.
Sure.
As interest rates change.
Yeah. So if rates come down, because the interest is accruing on the balance, right? Yeah,
that's kind of the actuarial side.
Yeah.
Is that, okay, it's growing faster, so we can't lend quite as much day one.
Yeah, because you don't want people to be upside down when they go to sell their house, or when they pass away, their family sells their house, right?
Yeah, the FHA is insuring these loans. So if it is upside down, we're satisfied as the lender or the investor is satisfied. So if you're upside down, this is one of the protections that a reverse mortgage has. It's a true non-recourse loan. So you could be upside down $1 million on a reverse. By law, we cannot come after it. That we can only collect whatever's lesser, the value of the home or the loan balance. So if you're upside down by $1 million, that's just letting the home go. And again, you would only do that if you then have passed, right? Otherwise, you just keep living there without a mortgage payment. There's no reason to leave unless physically you're unable to or something like that. And you could sign a deed in lieu and mail off the keys. So the FHA is trying to protect this insurance pool, right? Because it's a self-funded pool. And so they're always looking at that math and trying to make sure that they can cover those liabilities, which, of course, how it works, it all happens at once, right? There was a lot in 2011 when everyone was upside down. And then there's been a lot fewer now, right, as the market.
I mean, I guess the concern would be, we don't know the future, but real estate prices are really high. I don't know if, there'll definitely be some decline at some point, right? It's a question of how much, just because things always go up and down cyclically. But it
has to do with a lot of things.
Is now like, from an FHA standpoint, it doesn't matter to the consumer if it's a non-recourse loan, but are we going to be seeing in like 10 years, the people that did FHA loans now, really are underwater because home prices are down 30%. Yeah.
Right. That's really what it would take. Otherwise, it would take a very long reverse. We run out the amortization table. We go, here's what it's growing at, and usually it's about 30 years before they start to be upside down.
Sure.
Because typically the home's appreciating as well.
Yeah.
But that's all. It's all the fuzzy crystal ball.
Yeah.
Right? Where are we at 30 years home prices wise? Who knows? Yeah.
If we knew, we could time it perfectly.
Exactly.
Yeah.
Yeah.
So, all right. So you can start at 62. The older you are, the more you could borrow. Are there any other requirements people should know about?
I mean, there's income qualifying like a traditional mortgage. The home gets appraised. There's they're going to look at, if there's repairs needed on the property. So it's a very normal underwriting process. Credit history gets looked at, everything like that. So you are qualifying for a loan.
Is there a minimum credit that you need to have to take it out?
So we don't. It's a weird thing where this is where a lot of people say reverses are easy to qualify for. I think they're easier in some ways and harder in others. They're easier in the fact that we don't need you to make a mortgage payment. So there's not as high of an income requirement because we're not worried about you making a monthly payment. They're harder in that we don't look at credit score, but we look at credit history, and that includes property taxes and insurance payments. Because one of the ways you can default on a reverse mortgage is not paying your property taxes
and
homeowners
insurance.
Just
thinking, that.
And HOA. And so,
or insurance, right? I don't know if you said that, but
yeah, insurance, HOA, and property taxes are really important in the reverse mortgage world. So, a traditional lender, if you're late on a property tax for a traditional loan, is usually not going to be that big of a deal. It's a much bigger deal on the reverse side. And so it just changes the numbers significantly. And that can make or break it for some clients. And so, it's one of those things where there's not a minimum score, but if you have the things that make your score low will be a problem, right?
Sure.
All those lates and not paid or delinquencies, that's going to cause some issues. So it's kind of this funny thing where the actual score itself is not a factor in reverse, but really the underlying items that make or break that are. So, clean. You really want clean, paid on time.
Is there like if you were thinking about this, should you really tighten your belt, so to speak, paying things on time for 12 months or 2 years? Like how far back do you guys
2-3
look?
years? Yeah, for sure. We look at 2 years property tax history. 2 years HOA history. It can go back further on the credit side and bankruptcy. So always it's a good rule just for life, right? You should pay your bills on time.
If you can, right?
But it's just one of those things that some people might not be aware can be a bigger deal.
So what about everyone's property taxes are going up everywhere, right? I think you live in California, as you mentioned, and with the terrible fires, property taxes were already, I should say insurance. Property insurance costs are going up. They've already gone up. They're probably going to go up more. So is that a concern that people should have as far as how that might impact this, or?
Yeah, it's tough. California, we've been dealing with that for years. I'm up, where I live is up in the hills, and it's a tinderbox where the fire chief years ago said it's not if our city goes up, it's when. And I talked to him a year ago. I saw him at an event and said, has that gotten any better? He goes, it's just gotten worse. So, we've been dealing with this for a while, and it is always a concern. I've talked to, and that's one of those, really, we can't predict the future. And I want my clients, we try to focus on not using a reverse as a Band-Aid. And we really our hope is, hey, 5, 10, 15 years from now, you're really glad you made this decision. We can't foresee life. Things happen, but I had clients late last year that we looked at their numbers, and I was like, okay, as it stands, you're 3 months from being out of money. And I don't think they really sat down and did that math, right? Because if they had, I think they would have been talking to someone a lot sooner. I was like, even if we do the reverse on this home, you're a year at your current lifestyle. And so either you got to adjust your lifestyle way down, or you need to sell and downsize. We need to do the reverse on the next home, because now you can have a chunk of money to where you're going to last, several years. Because it's just they're more expensive than a traditional loan. We can kind of talk about differences of HELOC. That's one of the big ones, is a reverse is more expensive. So ideally, it's on your last house. we can never plan it. We've had clients do multiple where they end up moving and that kind of a thing. Like we said, we can't plan for everything in life, but ideally it's your last house. And that's when you're going to have the most gain from it, the most optimal use of it. And so, if we're looking at something, I've talked to clients that had a reverse for 10 years, and they're like, the homeowners insurance is what was pushing them out of the home, because they just, even though they didn't have a mortgage payment anymore, they couldn't do the homeowners insurance and the taxes anymore.
Yeah,
so they sold and took their equity and downsized. Right?
I mean,
you're always welcome to sell.
The point of this isn't to talk about as an alternative, but selling and renting is not a terrible thing for some people, because you just have the rental payment. Even if it's $3,000-$4,000 a month, that might be less than staying in your house with all the costs of maintenance and insurance.
Could be, and that's something that we've had clients where a lot of our clients, it's kind of the ostrich and the head in their sand, and we're just glad that they're actually looking at making a change to make their retirement more optimal. And so some of our clients, they just made the decision, I think it's going to be best that I just go into kind of a semi-care facility. And we're so happy to hear that, because okay, you made the decision, right? You're going to sell. That's what's best for you. That's awesome. And that's really hard. We're always talking to clients about, okay, you want to stay here, you want to reverse. Have you looked at downsizing? Have you looked at a home equity line? We want to make sure that we are exploring all our options, because it's not always the right time to do a reverse. And that's a big one,
Yeah.
Maybe this isn't the right home. Hey, this home's 3 stories. Right now it's okay, but are you really going to age in place here?
Sure. Yeah.
That kind of thing. Yeah, absolutely.
So if they do take it out, do they have options about, they can get a lump sum, or they can get like an annuity payment, or how does that work?
Yeah, so this is where the reverse kind of becomes the multifunction tool of person A's and person B's reverse can look completely different. It's very different. And, even comparing it to a home equity line, as you mentioned, hey, which one should we look at? It kind of seems like, they're just 2 variations or 2 sides of the same coin. And they're really not. They're very, very different. And so if we look at kind of the line of credit feature of a reverse, if you picture, the easiest way to picture it is someone who's free and clear, right? So maybe they have a $600,000 home, they're free and clear, and maybe we can offer $200,000, based on their age and interest rates. That by default would be a line of credit.
Okay.
So actually we're limited on how much. If they're free and clear, we can only give out 60% of that at closing.
Okay.
And really what the FHA is trying to do is they're really trying to limit, what are you going to go use this on? If we're paying off a mortgage, we're allowed to go over that. Exactly. They're trying to slow down that just take out debt and go use it. And that's the purpose for that. But really, so if you look at a traditional home equity line, typically you're going to have 10 years of open line of credit, and then it matures into a 20-year amortizing loan. So the first 10 years, you're paying interest only on what you've borrowed. You have this open line of credit. And then after that point, it's an amortizing loan for the next 20. So you're going to make payments to pay it down.
This is a home equity line of credit you're
That's
talking
a traditional home equity
Yes.
line. Yeah, traditional home equity line you can go get at the bank. The advantages are they're very inexpensive. Gives you good liquidity. Some of them are now you can pay with like a credit card and it goes to your home equity line, or you can write checks straight from it. It's very liquid. Some of the disadvantages are, they're adjustable rates and you have this payment. So, some people set up home equity lines a few years ago. Rates have jumped up. They're like, that's a bigger payment than we were hoping for.
Yeah, the rate could have doubled on them.
Yeah, absolutely. Probably has.
Yeah.
Yeah, it changes the cash flow picture. And so they're really good tools for short-term use. If we have clients that are looking at, hey, I just need $50,000, I'm going to fix up my house, sell it, and move. It's not typically a great use for a reverse. They're just more expensive. Go get a home equity line. You're going to pay it off in a couple of years. That sounds great. And so they're really good for short-term, or for people that are still in that kind of accumulating assets phase where they're looking to pay it down. We're going to add a bedroom. Our family's expanding. We have that low rate, so we don't really want to sell and buy a bigger house. That kind of a thing. That short-term, we're going to be able to service the debt and build assets. Reverse is really designed for retirement, and what we see retirees often do with the HELOC, the home equity lines, is they're kind of 60 or 70, and they're kind of starting to hurt. We're drawing too much. We're not quite making it. There's more month than there is money. And they're like, okay, I'm going to start pulling on this. And the problem that creates is 10 years down the line, when that amortizing payment comes, and I think what most retirees underestimate their longevity. I think a lot of people, we have clients that say, well, I'm not going to be here in 10 years. You go, well, you're 72. Statistically, you're very, very much going to be here.
Sure.
You're in perfect health, unless there's something we don't know. Very likely you're here. And so when it goes to the amortizing payment 10 years down the line, statistically that payment's 5 times what the interest-only payment was.
Oh, wow.
And so you're like, okay, you were in a bad position today. What's the likelihood you're in a better position 10 years from now when you're no longer working?
Let's say you're paying $400 a month, and now you got to pay $2,000 a month. That's a big difference.
Right, exactly. Yeah. And you were already kind of pulling on those funds to survive. So the reverse line of credit has no required monthly mortgage payment as long as they're living there and paying their property charges. So that you take out that negative cash flow piece, which is so important in retirement. But the line of credit also grows. And so this is the weird piece. This is where, so it was $200,000 day one. A year later, it might be $210,000. And then it might be $220,000. If you're not drawing on it, it's growing. So it grows at the same interest rate. So if you're at a 7% interest rate, your line of credit's growing at 7%.
Forever?
For as long as they're there living in the home, pay the property taxes, insurance.
Interesting.
So that becomes a very liquid, bigger pool of money where if you can put it in place strategically, hey, I know this is my last home. I don't need it today, but I might need it in 10 years for long-term care, or if something happens to one of my spouses and, I lose their Social Security income. This is where it becomes more of that insurance, that longevity insurance that, hey, it's a bucket. If you don't use it, no big deal. It's all home equity. But if you need it, we're really glad it's there. And the other thing about home equity lines is
7%. You're saying this is going to grow by $14,000 a year on a $200,000 mortgage?
Yeah.
Okay. And so, like,
again,
one year you
just,
get the next year you get an extra $14,000 you could take out of it.
Yeah, you could take out of it and still be at $200,000.
Oh wow, okay.
And you're not. A lot of times, clients especially like, oh, I'm making money. You're not making money. It's just available borrowing power.
Sure.
Right. It's just available liquidity on your home. It is debt. It will get paid back.
Correct. It's getting it's not free money. Yeah.
Right. And what's really great about it, and one of the reasons we really say there's not really a reason to pull this out and put it in the bank. In a traditional home equity line, if you remember 2009, they all got canceled or frozen or reduced. Like you thought you had a line of credit, not anymore. We cannot do that on the reverse. So again, as long as they're living there, paying their property taxes and insurance, that line of credit, we cannot freeze it, reduce it, cancel it, or lock it. So it is there, it's liquid. You have the risk of, what if I physically have to sell and move, or that kind of a thing. But otherwise, it's very, very liquid. And so that's where we're like, don't pull $50,000 out and put it in the bank, because now you're accruing 7% against your $50,000 just to sit in the bank. If you want a little bit, because it does take about 5 days to get access to that money, if we want a little bit, sure, for that kind of safekeeping or that comfortable emergency, but there's no reason to just kind of stick a huge bunch, because it's just growing for you and giving you more and more available borrowing power. And then that's where that chunk, that line of credit, can be turned on to monthly payments coming to you at any point. And so as that bucket gets bigger, as you get older, that monthly amount goes up every month. Once you turn it on, then it's a fixed amount, and you've locked that in for as long as you're living there and pay your property taxes and insurance. So it could be, we ran one, I think they had a $700,000 home. They're both 72, free and clear. If they turn on the income day one, it was about $1,700 a month. But they had no need today. They're fine. Their whole concern was just, hey, what if something happens to one of us, right? And we lose half the Social Security, where are we going to be at? So they're like, oh, that's great. Gives them, that almost replaced their Social Security. And we looked and we're like, when you're 84, it's projected. So the growth we don't know, because it is adjusting. So we don't actually, it's not locked in. And but when you're 84, that number is projected to be $4,300 a month.
Okay.
And she just fell back. Was like, did you just hear that? It was just so much comfort of, this is all home equity. It's our wealth. But if something happens, we get to turn that on. Right?
It's kind of like you mentioned the word annuity, but I'm generally not a big fan of annuities, but like a deferred annuity is kind of what this is, right? Where you give a lump sum up front, and if you live to 85, then you get money. But if you don't make it, not you don't get anything, because it's almost like a emergency annuity, basically. Like you're still alive, and now you really need the money.
Yeah, but we're using home equity.
Yeah.
And that's where we see it as an advantage is, it is almost identical to a deferred annuity. We could actually swap terms, and you could call the line of credit a benefit base, and it would make sense. And but instead of taking a liquid asset and making it illiquid by purchasing an annuity, we're going to take an illiquid asset and make it liquid. And it's all housing wealth. So if you don't end up using it, you're out the closing costs. But otherwise, it's all equity. So
Sure.
It's all going to be passed down anyway. And so you still have, that's like the death benefit, right? It's the remaining equity. You don't know what that's going to be because we don't know what house values are going to be at that point. But so it is kind of this emergency longevity insurance, long-term care insurance. You can kick the income is, the payments into high gear. If you're like, hey, I need $10,000 a month for long-term care. So then we go, okay, that's only going to last 3 years, or whatever the math says. But at least now you're in your home receiving that every month to pay for the in-home care. You could call again a year later and say, now it's 15, and it would just bring down that timeline. And so you can make adjustments, you can make changes, and start using the housing wealth to pay for in-home care. And then eventually, if you use that bucket up, now that's at the point where like, okay, now we're probably, selling and moving into a care facility and using the rest of the equity. But at least you get to extend that. 9 out of 10 want to pass in the home. 1 out of 10 actually do. But at least we can extend that period in the home.
Yeah. So the closing costs, like approximately how much is that to get this?
Yeah, so the biggest chunk is that insurance pool. So we talked about the FHA insurance, making it true non-recourse. It also protects you if the lender goes away as a company. So, those payments coming to you, that line of credit. If we had this in 2022, one of the fifth largest reverse mortgage companies shut its doors. So everyone with their loan with them just got transferred. FHA covered it. They actually just tightened. The FHA came out with their own rule tightening. They wanted to be faster at processing those payments. They're like, we can't, this can't take very long to recover those and start getting those payments out when something happens like this. So it's very, very protected, but that comes at a cost, right? And so the FHA has an upfront mortgage insurance of 2% of the appraised value up to their cap. And so it is financed in. So it'll be financed into the loan, but it's still a cost, right? It's going to come out. So for $500,000 home, that's $10,000, right off the top. That's going to go onto the loan balance day one. That's the biggest cost. After that, you have kind of your normal title, escrow, appraisal fees, your normal loan fees, and then there's an origination fee, and that's something that can be negotiated. It's the origination fee in the reverse mortgage world. We don't have points where you can buy down the rate. So the origination fee is kind of used like that lever. So you could do a $0 origination fee. You're going to have a higher interest rate.
Okay.
Or you can go up to the cap of $6,000 is the cap, is the highest origination fee, and you're going to get the lowest interest rate. So there's two sides. With points, you're like, okay, when's this going to pay off? That kind of a thing. But ultimately, because the lower the rate, the more is available to you, most clients are choosing to maximize that origination fee because they want the most available and then the lowest rate on the flip side. So, but again, that's something on a case by case.
Do some clients choose to pay the closing costs out of pocket, therefore they're not, accruing interest and reducing?
It's rare,
the equity?
but it's very strategic and it's a very smart move. So you can pay it down. You have to leave $100 on the loan balance. So whereas, you've gone through, if you're looking at a high value home, it could be $25,000 in closing costs, right? But you pay that down to $100. Now you got $7 a year of interest. Big whoop.
Until you start, right? So you're not.
Until you start pulling on it. Yeah. And what's amazing about that is every dollar you pay down becomes line of credit. So now you just made your line of credit that much bigger, and that is now growing. And so you really minimize, it's a way of looking at, like if you're comparing it to long-term care insurance where you're like, okay, we just priced out long-term care insurance, it's $1,000 a month for us. Well, what if we just pay down this reverse for 25 months or 20 months or whatever, right? And leave $100. Now we're done, and we know we have this big bucket of money that we can use for long-term care, with no claim process, right?
Sure.
For better or worse.
Yeah.
And that's the number one reason to do a reverse or not is behavior. Right. If you're someone that cannot leave that bucket alone and you're going to go, blow it on sports cars or whatever it is, right? And it's not the individual purchase that's a problem. For some clients, that could be a perfectly reasonable use of it, and for some, that could be not, right? So, but if it's going to go to waste and just kind of get burnt up, then yeah, like you're going to owe a lot on your home for what? But if you can leave it there and be strategic, paying it down and leaving that bucket alone for that what if, you're really lowering the true cost of insurance in that aspect, because you've only paid the $25,000 up front, or again, it changes on home value. I'm using that as an example, versus allowing that to grow over the years. That could become $150,000, $200,000 that's going to get paid out of the home as that's growing, whatever the interest rate is. So it's really, really strategic to pay that down and let it.
If you have the luxury of being able to do that, right? Not everybody does, but.
Luxury and strategic use of putting it in place before you need it. I think one of the big things is people wait. And really, when you look at the power of reverse mortgages, Wade Pfau with the American College of Financial Planning talks about the power of reverse mortgage happens outside the home. Right? It's about how we protect the other assets. So how we're, if we can use the home for long-term. Yeah, instead of the.
Because if you have an emergency, I happen to have it all the time. A client calls me, I need, $25,000. Well, if all their money's in the retirement account, that's a taxable distribution.
Right.
So that could mess up if they're getting a healthcare subsidy, it could mess up their Medicare premium, their taxes in general, which is fine. The money's there, but if they had something else to fall back on, that might be a better option, like the reverse mortgage.
Yeah, it's a way to help tax optimize. It doesn't affect Social Security provisional income. It doesn't affect Medicare Part A. So you really just have another bucket to utilize, and that's when it becomes really, really powerful.
And it's tax-free income as well, I'd imagine, right?
Yeah, it's a loan.
Yeah,
it's a loan. Sure. So the correct answer is seek a tax professional, but their draws on a loan.
Yes.
Yeah, exactly.
You don't pay taxes usually on a loan,
right?
How quick is the process to go through this?
I usually tell clients expect 45 days,
okay.
Especially in California, that we have some added time delays that they add. There's a counseling class that they have to go through. So they meet with a professional, a reverse mortgage professional, kind of go through what it would look like. And then if they decide to move forward, they would take a counseling class. It's done through a third party. And so they're the ones that are going to be like, hey, shop around, the origination fee is negotiable, that kind of thing. And so in California, we have an 8-day waiting period from when they complete that class before we can order the appraisal and title and everything. And so that just kind of adds some. The FHA has the ability to require a second appraisal. That can add a week or two of delay because you got to order another appraisal and wait for that to happen and come back. So, I usually say expect 45 days. We've closed some much faster than that. And then, of course, you get into all the what ifs that can go wrong with a loan, and they can go a lot longer, but most are around the 45-day mark.
Okay. Yeah. What else? Anything else? I'm sure there's a lot more, but what other things?
I could just drink from a fire hose for a few hours. No, it really is just added is, especially if you have a lot of liquidity, or you have a lot of your net worth in the home. It's something to look at. You don't have to do it. Right. Most reverse mortgage professionals, especially, you can go on to the, we call it NRMLA, the National Reverse Mortgage Lending Association website. They have a list of all the CRMPs. So you can find one, see if there's one in your local market, to just have the conversation, and look at what it would look like for you. And it might be something you do in a few years. It might be something you never do. But it's just good to explore what it could really do for you. I think reverse mortgages people are generally very afraid of. They've heard horror stories and don't realize that this is a government designed, Congress initiated product. It just took them a little while to correct some of the things they didn't foresee.
Sure.
But we've gotten now to where there's a lot of big changes that have happened over the years towards a very protected product. And then they've really fixed a lot of the issues. So.
That's good.
Just explore it.
Yeah.
And find a real professional that actually is in the reverse mortgage space.
Yeah. So to recap, the reverse mortgage or home equity line of credit, the home equity line is really like a short-term temporary thing. Probably not great if you're looking for income long-term, from your house
Yeah.
because you're going to have to pay that back. Usually it's a 10-year interest-only payment, and then it converts to a 15-year mortgage usually, right? Where
20 year.
20 year, where then you got to pay back the principal. Versus a home equity line of credit, you don't ever have to pay it back during your lifetime, right?
Reverse.
Reverse
As long as
mortgage.
you're living there.
Sorry,
living there and paying your property charges.
Yeah.
Yeah, and on the flip side, reverse is generally not a good short-term use.
Yeah.
Just because of those higher costs, it every now and then there's a use for it, but typically you should want to be there at least 5 years is kind of a general, financial planning. There's no broad, you can't just give a blanket statement. There's always different cases,
but some general rules, general
that's
thoughts.
kind of a general yellow flag. If we're moving in 3 years, we might hang tight.
Yeah.
Or we don't know.
You don't, yeah. And the home equity line too is probably a little faster.
Faster and way cheaper.
Cheaper. I mean, sometimes the banks don't charge you anything to actually take out the loan. It's just the interest that you're paying.
Right.
And you can pay it back. And short-term home improvement, short-term emergency. I recommend my clients usually do have a home equity line of credit established for those like emergencies unforeseen. And that way they don't have to tap their retirement account if they don't want to, or it doesn't make sense at that point. And then they can close it if they don't need it. But anytime, my philosophy has been when you want money, it's really hard to get from, a home equity line of credit perspective. Like you lost your job and you go to the bank and say, I need, no way, they're not going to give it to you. Or you're retired and you don't have income. So it can be a good idea to just have that as an emergency. And you might never use it, but it's just nice to have for that while you're still, working, or when you haven't gotten to the point where you need permanent income per se. Yeah,
it's like everything. Look ahead a little, prepare for the future.
Yeah,
it gives you much better results. Yeah,
awesome,
absolutely.
Yeah, well, I think we've covered a lot today. Is there anything else, Mitch, that you want to mention before we wrap up?
No, just take the time, learn a little more. Absolutely.
Awesome. Yeah.
Yeah, thank you for having me on.
Yeah, thanks for coming back. And, I'll put Mitch's information in the show notes so you can reach out to him if you need assistance. And, as always, this came from a listener question. If you have a listener question you want to have considered for a future episode, you can go to retirewithryan.com, click on Ask a Question to leave your question. Have a great week, everyone, and thanks again for coming on, Mitch.
Thank you.
All right, take care.